Hello, I'm Amber Reedy, and this is September 25 webinar with Canary Capital. We've got Josh Olszewicz and Stephen McClurg discussing the great cycle debate, navigating markets in 2025 and 2026. And so with that, I'll turn it over to Stephen to kick things off.
Great. Thanks everybody for joining. We are going to be talking about the great cycle debate. The biggest debate right now in the world of crypto is, will the 4-year cycle continue or is it dead? So, obviously we have mixed reviews on that. So, I actually believe that the 4-year cycle is still intact, that we, even though the effect of mining companies on the price of Bitcoin is getting less and less at each halving, it is quite conceivable that it's still a factor as mining companies need to continue to sell down Bitcoin to pay their bills. After, around this time is when they start doing that. And I've actually been watching mining companies very closely. There's some that are buying a ton of Bitcoin. The publicly traded ones are buying a ton of Bitcoin and adding it to their balance sheet. And the ones that are private are slowly unwinding, getting ready for this next bear cycle. There are a lot of people that are saying that miners are no longer relevant to the cycle, that there's other factors involved. There are some that are looking at looking at other correlations to Bitcoin and saying that we're now on a 5-year cycle. Or that we might be coming close to being on the regular economic cycle. And then there's, of course, some people that say that the number will always go up no matter what, and Bitcoin will just get higher with inflation, and it's a pure inflation hedge. A part of all of those are true. But I'm still in the camp of 4-year cycles for now. Just the effects will be less and less. Really, where I'm focusing on also is just like, at the end of every cycle, there's always events that cause Bitcoin and other crypto assets to run up into, what people think will be potential into infinity, and then the massive unwind when and leverage begins. So 4 years ago, we had the fall of Voyager, FTX, Celsius,
BlockFi, Celsius,
BlockFi, Genesis,
Three
Grayscale,
Arrows, yeah.
Three Arrow, yeah, all of them, right?
Yeah.
And they, kind of into the cycle, massive leverage, and then it all unwinds when the miners start selling their Bitcoin. Well, we're seeing it today. We're seeing it with all these treasury companies over the last year that have been building up their Bitcoin reserves, and sure enough, their MNAV has dropped below 1, and now they've got to unwind their Bitcoin to either pay their bills, because guess what? When you're running an operating company that doesn't really have an operating company or profits, or one that's potentially even losing money, or if you're running a publicly traded Bitcoin treasury company that has a ton of staff and a ton of payouts and a ton of fees and a ton of expenses, you got to pay those somehow. So you got to sell down your Bitcoin at the least opportune times. So I suspect that mining companies, particularly the private ones, will begin to unwind their positions, getting ready for the cycle. And it will have a knock-on effect to all the DATs, all the treasury companies, and they will eventually have to sell down as well. So for me, the 4-year cycle is still in effect. The drawdown will probably be a little bit less unless we coincide with the recession. But for now, we're still in a bull market, and we're going to continue to take advantage of it. But onto the macro side, which also has a big effect on the cycle. Just looking at rate cuts. We did get a rate cut in September. I do expect another rate cut this year, if not two. And when Powell is no longer chair, it's probably going to be more rate cuts. So that always bodes well for Bitcoin. and it's inflationary, and it could create a stagflation type environment. But that's for another day. This is where we are with rate cuts right now. There's also the big argument of, well, if Trump's trying to make the Fed not independent anymore. Well, the Fed's never been independent, first of all. For the last 4 years, it was controlled by Elizabeth Warren. Prior to that, it was almost entirely controlled by the banks. And I would even say in the last 4 years, it was controlled by the banks. And Elizabeth Warren is the bank's jockey. So now it's just shifting. So there's always been control of the Fed. It's never been independent. It's never supposed to be independent. And by the way, it's not even constitutional. So if maybe we should abolish the Fed, but that's a topic for another day. I'll have a conversation with Ron Paul about that. Looking at inflation, inflation, the rate of inflation has certainly come down. It's mainly because people can't afford things anymore. The typically those of us that are either on this call or involved in investing, we're going to fall within the 5% of Americans that aren't really feeling the pain. The rest of the country is feeling the pain and still can't afford groceries, still can't afford mortgage, still can't afford student loans, auto payments, because of the massive amounts of inflation we had in the last 5 years. But so even though the rate of inflation is down to 3%, it still doesn't alleviate the pain that a lot of people are feeling. So I do expect inflation to continue to be muted for that reason alone, just because people can't buy things. But unless there is a serious effort to control government spending, which I've been saying this in the last 3 administrations, including this one, that inflation will continue to rise. Government spending is continuing to be out of control. The rhetoric around, the Trump administration is that they were going to make all these cuts. Will bring down government spending, bring down government programs. There was a little bit of that with Doge, and then all of a sudden it disappeared, and the U.S. is spending more money than ever. So, every administration wants to spend more money. Now, we also have government shutdowns pending, which I do believe we will get a government shutdown. I'm all for less government and less government spending. The good news is with the government shutting down, there will be less spending. There is an aim to cut some waste, cut some staff across the board during this period of time. However, as my colleague Josh pointed out to me privately, that anytime the only solution to a government shutdown is agreement on spending, because everybody wants to spend, both sides. So probably we'll have some kind of agreement where there's going to be more spending and a higher debt ceiling, and the government will open back up again. We can only hope that the government will spend less and will shut down wasteful programs, but they won't. They'll just create more. So where does inflation go? Again, the government spending will continue to pull up, where the affordability of things for most Americans will continue to go down. So it'll probably stay in this pattern of about 3 to 4%. Is where I expect it to be, even with further rate cuts.
And I'll just add on the inflation front, it's hawks versus doves, right? And you're getting this data month over month, regardless of if you think the data is real or not. This is the data we have, and you're giving the hawks more ammo to say, you know what, maybe we shouldn't cut rates. Maybe we don't need 6 rate cuts in 2026 or whatever, right? So that isn't helping things from a market's perspective, even though people are continuing to price in aggressive cuts and aggressive easing. It's certainly not helping the story of, hey, we should be doing this. This is the right reason, et cetera, et cetera.
Yep. Well, this is my favorite factor to look at when I'm looking at the price of Bitcoin, and it is into monetary supply. Um, what we're showing here is US, and of course, it continues to rise. I like to look at global because Bitcoin is a global asset. But if you look at this chart here, gold, of course, has had a massive rally this year. Gold bugs have aptly pointed out that over the last year, gold has outperformed Bitcoin. Therefore, 1 year performance means everything. But that's called cherry picking data. If you look at overall data, Bitcoin has massively outperformed gold, and even if it's for a short period of time, it hasn't. That's okay. Bitcoin had a massive run up until January. So we've gotten some mean reversion so far this year. It's been a sloppy year for a lot of traders, 2025 in this market, but our expectation is that with new all-time highs on both US and global into monetary supply, Bitcoin will rally. And sure enough, it is rallying even as we speak, going above 115. My target, and again, we all, that's the beauty of having multiple people on a team and multiple ways of looking at data. We all have different targets, and we come together to try to make a decision on how to trade, and how to manage assets for those targets. But my target still stands at 140. There's a lot of big numbers out there like 200 and 250, and there's still people that are saying that it could hit 1 million. I think that's absolute crazy, but anything's possible. But my expectation is that the month of October is going to be a massive swing for all crypto. Bitcoin could even hit that 140 mark this month, or the month of October. It's probably not until November, but it'll definitely get close this month if things go the way that we believe they will. And then that also comes with an altcoin rally. So August wasn't a great month for altcoins, and but we still have conviction that another rally is coming in Q4 of this year.
So this next slide's on the yield curve, and before we talk about it, I bring this up every month, right? Like the slide hasn't changed really, but the main question is, where should the yield curve go? And then the secondary question is, what should the trend of unemployment be in response to that? That's my question for you, Stephen.
Yeah. So the first one is on the yield curve. I want to see a normal yield curve. It's very difficult as an investor to get a better return for assets that have more risk than assets that have less. And as long as the curve is inverted, and by the way, the reason why the curve is inverted the way that it is the Fed is artificially holding up short-term rates. And I know that we were just complaining that, sure that the Fed's probably going to cut rates. And we probably see, more inflation, more government spending. But the issue really is at the short end of the curve. And with the Fed artificially holding that rate up, the curve wants to come down at that rate, which is why you still see an inversion. But the long end of the curve should actually go up. And the Fed could and should, and I wrote a paper about this, and it looks like Powell is listening to me, even though he has no idea who I am. But it looks like the Fed might actually do what I suggest, and that is continue to lower rates, but unwind the long end of the balance sheet. And that should take rates up higher on the long end and bring it down on the short end. Why is this important? Well, we just talked about how people can't really afford things right now. And the low end of the curve, the short end of the curve, actually controls short-term rates, which affect things like student loans, auto loans, and credit cards. So those are really the areas where most Americans are struggling to pay. So if we can get the short end lower, that helps out that segment, and then the long end needs to stay up because we've had a massive rally in real estate prices. Real estate is out of control and unaffordable for most Americans, and home prices need to stay where they're at or even come in to be affordable again. Now, part of home affordability is due to rates, but the actual price of the home, not just, not the cost, is a factor. And that needs to either come down or stay flat for a period of time before rates can come in on the long end. So we need to see a normalized curve so that investors can make, bond investors can actually make, better decisions on what part of the curve to buy. And then of course, unemployment is something that I've talked about a lot. It's way below 5%. And even though it's starting to trend upward, it's still too low. And I do want to see the unemployment rate get back up to 5% because that is the natural rate. And I know I talk about this a lot, but we need to get unemployment back to a normal rate and then try to hold it steady there. Now, of course, Fed does a terrible job of holding things steady. But that is the best thing for the economy. So the long end needs to stay high for those two things to happen, and the short end does need to come down. All
So on the
right,
GDP, I'll just step in for a quick second.
do it.
There's this talk about recession stuff, regardless of your political leaning. And again, back to the data, the bottom line is you can't get a recession when the data looks like this. So the GDP is an aggregation of retail spending, exports, other stuff, capex, investments, right? And just at least for this quarter, you cannot have an NVER declared recession if we do not have back-to-back negative quarters. Now, we may have other recessionary activity, recessionary feeling, a vibe session, but the NVER, what is that? The National Business something something. They're not going to declare a recession, right? So I think it's going to be hard for markets to go in the opposite direction. Again, if we're taking all these data points in aggregate, saying, okay, what do we think is going to be the outcome for Q4 and beyond? Just looking at where the Q3 estimate is, and if you remember the Q2 estimate, which was much lower, it's a complete like bullwhip effect, basically, of GDP. I don't know if you have any thoughts on that, Stephen.
Yeah, look, I take everything that the Fed states for estimates with a grain of salt. They rarely get it right, and they rarely make the right decisions based on what their estimates are. Um, so I do see some acceleration of growth possible, mainly because we're closing off a bit from the rest of the world and trying to produce our own things, which is good for growth in the U.S. economy. But look, at the same time, there are certain sectors, and I mean, mostly in areas of employment that are starting to trend towards higher unemployment, which means that people will begin to spend less. So I don't expect to see a deceleration of GDP anytime soon, but potentially in 2026 is when GDP could enter into recession land.
And I guess also on the macro side, do you have any thoughts on, I don't know if you know about dollar milkshake theory, everyone's favorite USD theory from Brett Johnson, but there's this idea that everything's going to flow into the US dollar, but that hasn't happened based on the DXY index since Trump took office. So the question for you, Stephen, is how low do you think the dollar should go, needs to go, will go in the next quarter and maybe even throughout 2026?
Well, what's interesting is that the stable coin legislation is actually going to help US dollar and US treasuries. And it always has. I think, particularly, um, you know, particularly the Trump administration understands that, which is why a lot of these bills have passed, like the Genius Act. What's offsetting that, though, is during the last administration, we weaponized SWIFT, cut off Russia, and now a lot of parts of the world are saying, well, we don't really need the dollar anymore, then I guess. We don't need SWIFT. So Russia and China and several other countries are colluding to get off the dollar altogether. So, there's digital renminbi isn't just a rumor, it's real. And I do expect to see some kind of digital currency that supports most of the BRICS. It could be more based on the renminbi, but even if you look at U.S. Treasury sales to China, which is one of the largest holders, then it's actually decreased. So look, all of these are a factor, and we'll see which way it goes. I think the jury's still out.
Yeah, and I'll just add that if we see insane speculation, froth in crypto and alts in Q4, it will probably very likely be coupled with continued devaluation of the US dollar. And I mean, this is another reason why gold is having such a great year. It's inverse. It goes hand in hand, obviously. And then another point here for the macro before we go shift into the crypto data. As Stephen mentioned with the M2, it's not just the US where we're seeing easing, where we're seeing global liquidity increase significantly. It is also on the central bank side, we're seeing not just the US bring rates down, we're seeing everybody bring rates down. And this is from Larry Adam at Raymond James, but it shows over 80% of global central banks have cut rates in the past 6 months. And again, it's like, okay, what are the outputs of that? Well, it's more money in the ecosystem. And again, what would you expect gold to do? What do you expect to fixed supply assets to do? They should do very, very well. That's what happened, on the back of 2020 as well.
Yeah. Well, look, global rate cutting, not just the U.S., is what's contributing to M2 money supply, which has a very strong correlation to Bitcoin and has for a while. The correlation isn't actually as high to gold. So usually what happens is gold doesn't have a strong correlation to inflation or money supply. It's usually a front runner to those things. So people typically speculate on gold if they expect there to be high inflation or high money supply. And then when that actually begins to happen, they pull back. So I do expect, look, gold has had its day this year with anticipation of potential higher inflation with rate cuts, higher money supply globally. But now that time is probably getting close to being, to slowing down. And this is the time where Bitcoin picks it back up. So, just based on the correlation data, that's where we get the 140 number for Bitcoin for the year.
Great. And if we get back to the cycle debate part of things, this is why people are starting to get nervous if we compare just duration of the cycle, not even looking at the percentage return, but just the duration from what we've seen in prior cycles from the bottom to the high. How many days has that been? And it's about as many days as we've seen in the prior two cycles, and it's more than we've seen even in the 2011 cycle. So obviously, we have 3 data points here. It's not 500 years of data, but what we have is what we have. And there is certainly a risk here that not only people are sort of expecting it and front running it and trading around it, but that we undershoot something percentage wise. We don't hit multiple targets. I might sound conservative or not bullish, but that's definitely not the case. I mean, it's just, like, let's be real here. It's been 1,000 days since the low. We're up 8x since FTX blew up, and we've done very, very well. As Stephen mentioned with the DATs, that's certainly going to be a contributing factor on the way up and on the way down. We saw that with ETH ICOs, in 2017. It feels really, really good on the way up, and things get real on the way down when everybody's selling their crypto for whatever reason, management getting back to 1 MNAV, whatever it is. So that's definitely something to watch. That's like a 2026 problem. But in the here and now, I do think we have a little bit of time in Q4, and then that's if the cycle is the same as previous cycles. We could extend it into 2026. We're talking about money supply going through the moon. We're talking about rates going lower. All that stuff can help contribute to an extended cycle. And just anecdotally, when I talk to people about this, it's usually the TradFi guys who are who have this reply to me where they're like, what do you mean the cycle's almost over or whatever? They say, but we have XYZ components here on the input side that could continue to fuel this higher. So if that sentiment is true and we see things like the ETF flows continue into 2026, that's a really, really good sign. If we look at the ETF flows weekly here for BTC and ETH, BTC in the yellow, ETH in the purple, we haven't seen super consistent flows recently. ETH had a couple weeks there with the really, really high inflows, and we saw ETH price go from what was it, 1,500 to 4,000 or something like that, very, very quickly. Price certainly helps the inflows. It's kind of self-fulfilling prophecy there, brings people in for sure. But lately, that's sort of dipped off. So the question I think a lot of people are asking, with these ETFs in particular, what will flows look like? Obviously, the more flows, the better here for price. The next question, will we see new ETFs take the mantle or take the torch? Will they be leading in Q4 as we get some more crypto ETFs? Very likely. And then people are also wondering on staking, what impact and effect will that have for things like ETH and Sol and other products that have a yield component? So in the here and now, again, it's like, flows kind of dropping off a little bit. That's okay. September seasonally bearish. Now it's up to Q4 to see, are we going to see rotation out of equities and Mag 7 into things like BTC that has kind of languished a little bit, out of gold into BTC that has languished on a relative value pair. So those are things to watch for here in October. On the seasonality side, this is another reason people are just, they're thinking about the 4-year cycle. They're wondering, okay, we're only up, air quotes, 20% this year for BTC. If we look at previous cycles, we have kind of exploded higher in either the previous year or this year of the cycle, and 2026 would be the negative year potentially. So if I had to bet on any time of both the cycle and just the monthly return basis, if we look at October, November, December for Q4, the average and median return generally very, very positive. This is post-COVID. Pre-COVID, it's even more dramatic for Q4. So if there was any time that I would expect, just blindly based on seasonality, things to do well, I'd expect flows to do well, we have it. This is it. We also have, again, all these macro data points that are feeding into the potential for this to be a big month and a big quarter. Like we keep talking about gold, it's obviously top of mind because gold has done very well and Bitcoin has just done well. If we look at on the left side here on the chart, that's BTC against gold. The ratio there is around 30. That's actually less than it was in 2021. So on a relative basis against gold, we really haven't gained that much ground compared to 2021. And even against the S&P on the right side there, the right graph, we have gained, significant ground since the lows and continuously. Great. But in the grand scheme of things, relative to 2021, we have made a new higher high. We have made a new all-time high on a relative basis, but we are not, to me, way overbought or way outside of a realm of expectation on a relative value basis. So this to me, just like the gold and the silver people talk about ratios or whatever, to me it's like, okay, if we're trying to normalize this in real terms, what does that look like? It looks like this, relative to gold, we could certainly move higher. The price is the price in USD, but relative to gold, I think we have some room to move higher. On the technical analysis front, which is some people's favorite, some people's some people really don't like technicals. That's okay, but on that front, for a price model for BTC, a popular price model is the power law corridor, not just because it just continually goes up and to the right, but after it was discovered and since then, it's done a decent job at giving you some idea of where we may be headed in a cycle. It gives you sort of overbought, oversold conditions similar to an oscillator. So currently in that oscillator, we look relatively tame. Again, and the price is the price. And if we're looking at data inputs from all over the place, the specific model says we have plenty of room for what Raul Paul calls the banana zone, right? We have plenty of room for, I don't know about 1.2 million or 400K, but we have plenty of room for higher at the very least. Its price is still below the midpoint of this model. In the very near term, zooming into like the past couple months, we have formed with price action a potential bullish reversal chart pattern called the inverted head and shoulders. If you are ever in the presence of any sort of technical analysis, you'll hear this term over and over and over again, and you'll understand that this is a very common chart pattern. It looks just like this. You know, it's got an extreme low in the middle, and it's got two higher lows on the right and left of it. The key level here is described as the neckline. That's in this case a diagonal level, somewhere around 115, and trading this on a breakout would be wanting a daily close above 115 with a target essentially to 140 based on the depth of the pattern. So that's how you would read that in technicals. And it's also important to note, you know, we're not just showing this because it's a webinar and I need something to talk about. Like it's legitimately, this is what we have, right? If you look at ETH does not look like this. Solana does not look like this. Those are both kind of nothing burgers right now from a setups perspective, which to me just signifies, again, that's not where the market's probably going to be for October initially. It's probably going to be a Bitcoin show. If we look at another technical indicator called the Bollinger Bands, these help understand price volatility. So if we go to the weekly time frame in this case, and we look at Bollinger Bands since 2014, when the Bollinger Bands squeeze, that says you should start to pay attention. You may get a high volatility move soon. So we're currently in one such contraction period that is the tightest we've ever seen. Such as says the volatility, despite the price action that may feel like, you know, nonsense chop, on the weekly basis, we have done very little here to expand outside of the standard deviations of the indicator. So that's a lot of words to just say, if we start to deviate higher or lower from those bands, that will probably set the direction for the next couple weeks with a decent move to follow. That's historically what we've seen. We don't see contractions and expansions like this without an explosive move in one direction or the other. You know, it feels like a coin flip, sure, based on the Bollinger Bands, but if we consolidate above that green line there, that midpoint, that's a very good sign, hinting at bullish expansion versus bearish expansion. If we shift gears a little bit to altcoins, which certainly need Bitcoin to do well, but if we look at the year-to-date returns, this is just basically the top 20-ish altcoins. It's kind of all over the map. You know, we've got Bitcoin at 22. We've got meme coins, Doge and SHIB that are down. We've got other layer ones that are down. We've got exchange tokens, BNB doing well, Hype doing well, Crow doing well, and kind of everything else in between that's just sort of flat or down year to date, and certainly down significantly relative to BTC. So if I'm looking for trading opportunities on a relative basis, I would love to see the relative move of BTC get outstretched compared to some of these coins, and then look to rotate into things down the stack in the mid cap land later on in October, potentially into November. But we will probably see anything with a DAT do very well, anything with an ETF do very well on a relative basis compared to those that don't. I mean, that's probably common sense, but if you don't have the flows, then how are you going to do better than those that do? It's going to be very, very tough. Altcoins, of course, also thrive on stimulus in the US and globally. We certainly have that now to a degree, right? Just two headlines that I pulled over the past week. One of them, New York households are being mailed $400 inflation refund checks. So if you're in New York, congratulations. You know, that's not going to move the altcoin market, but it's a start, right? If we're trying to figure out where's this money going to go. At this point, I think the altcoin market in a crypto native sense is probably competing with things like DraftKings or Robinhood or legacy markets. There's a lot of quantum stuff that's doing very well. You know, gambling type activity is certainly competing with alts. Alaska's also talking about distributing a dividend payment. And then, of course, Trump himself has floated the idea of a tariff stimulus check, which hasn't quite come to fruition, but maybe it's something he dangles in midterms next year. Looking at Bitcoin dominance on the right there, this is Bitcoin on a market cap level relative to everything else against it. So currently Bitcoin makes up around 60% of the total market. And what we've seen historically in alt season, as it's called, when alts do very well, is dominance dropping from 60% to roughly 40%. So there is a little bit of that relative ammo, kinetic energy, where the pendulum could swing to alts in Q4, just because the most of the value has gone towards BTC since ETFs in 2024. Stablecoins can also act as a stimulant for activity in the altcoin market. So stablecoins up and to the right here is and should also help alts eventually do well. Alts that don't have an ETF, alts that don't have a DAT. For people who are unaware, stablecoins act as a cash layer for crypto traders. They are directly involved in trading pair denominations. They're involved in DeFi applications, DeFi, decentralized finance. You can't get connected to JP Morgan, okay? Like you need some sort of cash-like vehicle to help move things around, increase capital efficiency. And of course, moving into stables helps you reduce volatility or downside by sitting in that dollar value. And on stablecoins themselves, the businesses also help on and off ramp dollars in and out of the ecosystem. So currently Tether and USDC are continuing to gobble up USD, sit on T-bills, and not provide the yield to users if you're Tether, but USDC does pass along a little bit of that yield to users. But the point is, again, if Tether continues to mint and print stablecoins, one would think eventually this should lift alts as well. Even though stablecoins aren't just used for trading purposes, they're also used actually for global USD checking and savings, especially in emerging markets. If you go to South America, you go to certain countries in Europe, Asia, you'll see Tether just asked for as a currency, which is super cool from a crypto perspective. So that's also helping fuel Tether's dominance globally. And you could see just since the US election, that was really kind of the inflection point for both Tether and USDC to just explode in circulating supply. And on the ETH front, just on a technical basis from the network, one thing to watch about, I mentioned staking with the ETFs. There is this sentiment gauge you could think about with ETH staking. For the network itself, there's a queue. You have to select yourself to join the staking queue. If the staking queue is empty, it's fairly instant. If the staking queue piles up with a lot of people asking to leave or enter, there will be a delay in that. So currently we're seeing significant outflows from the staking component of ETH. A lot of that is related to one of the validators that got hacked. Kiln is rotating validators around. That should clear eventually this quarter. But it's going to be very interesting if, let's say, ETH goes to 5, 6, 7, 8K. What will the validator queue look like then? You know, are people locking their ETH up, or are they selling it, right? Are they taking it out of the ecosystem and are they selling it? So also something important to watch in Q4. And on the ETF front, I would expect that this entry queue, that blue line here, this is going to explode if all the ETFs start staking, explode higher, in a good way, because the staking provider or the ETF providers are going to want to pass that staking component on to users in the form of a yield. In a technical basis, looks like my chart's not loading here. That's okay. TLDR of this one, the TA for ETH right now is basically a descending broadening wedge on ultra high time frames, and that points to a measured move somewhere between 5K and 8K. The issue is the time component. How long is it going to take ETH to do that? Is it going to take it 2 months? Is it going to take into December, January? Anybody's guess, but very possible it takes longer than you'd expect. And then lastly here, another chart that's not loading for me, unfortunately, also is a comparison between ETH and the Russell 2000, which interestingly, IWM and ETH, they look identical chart-wise. And if you're bullish small caps in equity land, you should also be bullish ETH and vice versa. If you're not bullish Russell 2000 for whatever reason, then I think ETH may be more challenging to move higher. And it's probably the case because, again, we're talking about relative values and we're talking about money moving around between high caps and low caps, and what type of environment it takes to move that money around where people feel comfortable speculating down the risk curve again. So if you're bullish Russell, you should be bullish ETH. And then real quick here as we finish, a lot of talk about DATs. We'll do a deeper dive on DATs next month. If you're unfamiliar, these are companies that are buying crypto on the balance sheet, and they could be either uniquely focused on a specific coin, multiple coins, or they're just adding it to their treasury. Most of the DATs that we've seen recently are essentially shell companies that are treasury specific for one token. One metric you can use to look at these and stack them up against each other would be MNAV. MNAV is the net asset multiple based on outstanding shares. And there's a lot of like wishy-washy math in here, but the very basic bare bones equation is market cap over the crypto treasury value. If it's below 1, it's a discount. If it's above 1, it's a premium. We've seen a lot of these start off at a premium and decay over the past couple months. There was a lot of excitement initially for some of these, and that has really slowed down a lot. You know, this is aggregating each of these by coin. If you go under the hood of some of these, as Stephen mentioned in the open, some of them are already at a discount. We're seeing mergers of DATs. We're seeing more DATs still pop up. One thing to watch in Q4 is, do these DATs start to get a premium broadly, you know, or do multiple start to get a premium? Does MSTR, does its MNAV expand? Does Metaplanet's MNAV expand? You know, that is a sign of frothy stuff, right, going on. You know, we're not seeing that now. We're seeing the DAT bubble sort of deflate, if you will, in recent weeks. So for the moment, you know, this doesn't look like alt season, right? This looks like people are not speculating high on leverage on these companies. Whether or not they should is another question, but I expect to see that if alts do very well in Q4. That's all I had today. Amber, do you have any questions from the chat by chance?
We don't at the moment, but if anybody has any questions, feel free to shoot them over. I'm gonna give it another minute or two and see if anybody has anything. If not, you guys can feel free to email us with those questions and we can get back to you directly.
Okay, sounds good. I think we're all set for today. Thanks for coming to our September 2025 webinar. I look forward to October.
Question.
Go ahead.
What do you think are the top 3 catalysts for potential alt season ranked?
I mentioned stimulus. We certainly have easing already. I think that's in the list. Easy money, you know, rates as low as possible. ETFs and DATs having direct access to a bigger capital flows. And a third one, I think just the relative value. You know, you need, for me and us here at Canary, to trade into an alt, we certainly need a technical analysis reason. You know, we're not just saying, oh, this one is super low on a relative basis to BTC, but if you have a relative value that is low enough coupled with technical analysis, you know, that I think is a setup for doing well in Q4 alt season, because then you start to see people rotate around. They already made their money in some place. They're looking for something else to do. You know, the hot ball of money starts to rotate around into other things that haven't seen movement. You know, if we go back to this year to date chart here, you know, some of these alts, these are just like the top 20, but if we go down the list, we're talking 60-80% on a USD basis, and on a BTC basis, it's like 90%. I mean, it's a bloodbath out there for some alts for sure.
We have one more.
Sure.
What is the thought on XRP ETFs and its price in general?
Can't comment directly on any XRP ETF filing, but what I will say is any alt that has an ability to gain flows via public markets should and could potentially may see that flow in Q4, right? Especially if it's never had that. I mean, I would caution people with early expectations of flows. If you think about ETH had no flows for like months, right? And then finally, again, if we go back to this, I'll just scroll through it. If we go back to this slide, the ETH ETFs launched mid 2024. Really saw no flows until the end of the year, and then only recently in 2025 finally saw flows. So ETFs aren't a use case for a digital asset, but if people are trying to express an idea, they can do that through ETFs if they so choose, if they're trying to gain access to any coin. So if you have the flows coupled with, you've been ranging, you know, like XRP, for example, on a technical basis, has been ranging for months and months and months, really the entire year. If a good base can be put in, coupled with flows, I think that's a recipe for a decent move higher in Q4, or maybe even into 2026. And I think we'll leave it there. Thanks everybody for coming, and we'll see you next time. Take care.